Hey everyone, welcome back to Women, Wealth, and What Matters. 5 things with Tracy Byrnes. As always, you're going to learn 5 things and then you're going to go get on with your day because we are all busy juggling way too many things these days. So, this show is about helping women feel confident, informed, and in control of their financial lives. Whether you're building wealth, protecting it, rebuilding it, we're just trying to understand what the heck is going on out there. What changed in Washington in particular? So today we're going to talk about taxes because here's the truth. The tax headlines are loud, but your paycheck is personal. And for women, tax changes often land differently. Women are way more likely to take career breaks, work part time at some point, earn tips or contract income, care for children, aging parents, live longer. And quite frankly, so many of us end up managing money solo later in life. So small rule changes can have long term ripple effects. Now, this one big, beautiful bill act, which was signed July 2025, made many of the 2017 tax rates permanent, which is super great because stability matters. But predictability, on the other hand, matters too. Was also introduced, though, this one big, beautiful bill introduced a ton of new stuff, new deductions, new thresholds, and planning, quite frankly, nuances that could affect your 2026 tax return. So, believe it or not, I actually wrote a book about all this. I know. And if you're looking for something to put you to sleep at night, go check it out. I'm kidding. Deduct Everything, What You Need to Know About Trump's Tax Cuts and the One Big Beautiful Bill Act is the name of the book. And honestly, though, it's written in tips. It's small, digestible bites. You could read it. Just go to the sections you need, put it down, move on with your life. Because quite frankly, we need to break this bill down. Today, we're going to break it down into 5 things women need to understand. So there's no politics, no panic, just clarity. The bill is complicated. And there are many headlines out there that are misleading. So we're going to do this. As a reminder, though, this is a general conversation. This is not tax advice. Please consult your accountant, tax advisor, somebody before making decisions. Okay, let's dive into this now because, again, there have been a lot of headlines out there, and quite frankly, some of them are misleading. But the first thing we're going to talk about, what everybody's talking about, is your tax on tips, tip income. Just to kill the story right here. It's a deduction. It's not a free pass. You may have heard, no tax on tips, no tax on tips. This is a beautiful headline. It's just not exactly true. And that's not exactly what happened. All right. So the law allows eligible workers to deduct up to $25,000 of qualified tip income as an above the line deduction. That's wonky, but that basically means you don't have to itemize to get this deduction. So you don't have to go filling out that Schedule A itemized deductions in order to get this deduction. You're going to get it no matter what. But here's the change. And here's the piece that I think the media is missing. You must still report all your tips. You still will owe Social Security and Medicare taxes on that income. That is a very important point. You still owe Social Security and Medicare. Quite frankly, you want to pay into Social Security. I mean, fingers and toes crossed that we're actually going to get Social Security when we're old. But that said, someone will, and you need to pay into it. And the other thing is that the deduction phases out at higher income levels. So it's not an across the board deduction. It is not tax free income. Yes, it reduces your federal taxable income, and that's super important and requires a little bit of an example. So stay with me here. Okay, let's just say you're a restaurant manager or a hairstylist, and you earn $50,000 in wages, and you reported an additional $20,000 in tips. Well, if you qualify for the full deduction, that $20,000 will reduce your taxable income. That means you get to lob it off your total income line on your tax return. So for argument's sake, let's say you're in the 22% federal tax bracket. That could save you about $4,400 in federal tax. That's huge. I am not discounting that. But please remember, you still paid payroll taxes. That's 7.65% on that full 20,000. So it's not a free ride. It's certainly helpful. And it's wonderful for those of you out there that do get paid in tips. But please know it's not a free pass. And here's where women need to pay more attention. If your total income is close to that phase out range, a raise, a bonus, even a side hustle could completely reduce that benefit. So that means planning here is super important. So we're not just going to celebrate a headline. We're going to be super smart. Understanding the difference between tax-free and tax deductible. One, makes you smarter. Two, protects your long-term planning. Okay, so that's really important because so many people are in the hospitality service business where they get tips. Second big thing out there that everyone's talking about is overtime pay. Now, again, this is super helpful. It's not, though, that simple. Overtime income now may be, wait for it, partially deductible, up to $12,500. Again, this reduces your federal taxable income. Super. But it does not reduce your payroll tax. You still pay Social Security, Medicare on your on your full overtime wages. Now, many of you have overtime in your W-2. Depends on how it's reported. If it's in your W-2, they are taking Social Security and Medicare out. You're not going to skip that step here. And again, I think it's really important that you do pay into Social Security. I know I'm the only one out there that believes I'm going to get a Social Security check. I'm really hoping it's going to go to my daily bottle of champagne someday. I don't care. I'm going to pay and I'm going to stay glass half full. All right, we need another example here. Let's say you're a nurse, a teacher, corporate employee, and you worked extra hours. You earned overtime. Let's say you earned $15,000 in overtime. If you qualify for that full deduction, that $12,500 deduction, and again, you're in that 22% tax bracket, you could see your federal income tax drop by about $2,750. That is super meaningful. But again, we're not wiping out that whole overtime amount. That doesn't just disappear. It is still there. You just get a break on some of it. Okay, big note. Your paycheck does not automatically reflect that deduction. Unless you adjust your withholdings, you're not going to feel that benefit till you file your tax return. And let me tell you something, a lot of employers are going to be behind the eight ball for 2025 on this. So you are going to have to do a little bit of legwork yourself. Make sure you know what your overtime amount is when you go to your tax preparer or your accountant. Hand them that number. Show proof of it because it's not going to be, it may or may not be on your W-2. Now remember, this phases out. $150,000 for single filers, $300,000 for married couples. So again, if you're close to that and you think you're going to get a bonus or some extra stock compensation, your eligibility could shrink. So here's where it matters for women, especially. Many women increase overtime, even temporarily after a divorce, during a caregiving transition, right? While they're rebuilding savings, especially after divorce, everyone's trying to catch up. You put in some overtime. Be very careful here. Watch those thresholds. Talk to your tax preparer. If your income fluctuates year to year, this deduction actually may not be even constant for you, but that's okay. You get it one year, not the other. Put it all in one year, push it forward, pull it back, play around with it, because that way you can maximize the money in your pocket. You can't build a budget, though, assuming it will always be there, because overtime is still taxable. And there is just now a strategic layer that you need to think about and you need to plan for. So, all of you out there making overtime, God bless you, working so hard. Think about it, talk to your preparer, because you need to get as much benefit for it as possible. Okay, number 3, a lot of people are talking about this one. Car loan interest. The deduction is back. Not shockingly, there are limits. Okay, so interest on certain new personal use auto loans is now deductible up to $10,000 per year. But, and this is a big but, the vehicle must be new, so you can't go buy a used car. There are income phase outs, as there are with just about everything in this tax code. So as I mentioned, used cars do not qualify. Business vehicles are separate. That's a whole nother story. So if you go out and you buy a brand new vehicle, fantastic. Let me just say, this deduction does not give you justification to go buy a new car. Let's be smart. You need a car, great. But don't just go buy one because you get a deduction now. Tax awareness should inform these major purchases, not drive them. Okay, number 4, and my favorite. If you are over 50 and you earn over $150,000, your 401k just changed. This is now you are employed and you have an employer sponsor retirement plan. Starting in 2026, if you're over 50 and earn more than $150,000 last year, your catch-up contribution, that extra money that the government says, oh, by the way, you're getting old, you should save more, that now must go into a Roth IRA account. Think about that. Okay. So those of you that were doing the catch up contribution and increasing your 401k, now your employer must somehow provide you a Roth IRA option. Give them a minute. They're going to be behind the eight ball on this as well because they have to set this up. There's a reason for this, right? Like think this through. We're not stupid. Why the Roth and not continue to add to your 401k? Well, you don't get a deduction today. What does that mean? It means the IRS, or the government, I should say, gets your money today because they need it, sidebar. So when you make a contribution to a Roth, right, it's after tax dollars. So you will now pay tax on those catch-up contributions. Well, short term happiness for the IRS and for the federal government. They need your money today, so this is a workaround for them. But what it means for you is tax-free growth in the future, and better yet, tax-free withdrawals later. This is why I love it. So yes, your paycheck may feel slightly smaller because that catch-up contribution will be taxed today, and you're going to feel that. But and for women in particular, because there's no secret here, we live longer. That means we have a longer time to support ourselves. We are more likely to manage our money solo later on in life. And many women actually experience what they call this widow's tax bracket. All right, so what does that mean? That means, well, you're a widow. You and your spouse filed jointly in retirement with, let's call it $120,000 of taxable income. So that might keep you in a moderate tax bracket. But if your spouse passes away and now you file single person in that same $120,000 income range, you just got pushed into a higher tax bracket. So it could change your tax situation because the single brackets are a little bit more compressed. You could pay more tax on that same income simply because your filing status changed. This is why having this Roth IRA later in life is pretty spectacular, because when you pull out that money to live, you're not going to pay a dime on it and it won't go towards your taxable income. So again, this is why. Imagine this Roth. This is tax-free income. This gives you flexibility. It reduces that bracket creep, Medicare premium charges, and of course, those required minimum distribution spikes. So yes, you're going to lose a deduction today on the catch-up piece only, but you actually gain some long-term protection. I think this is super important. If that still didn't make sense, please make sure you reach out to me, because it is really important for those of us up there who are making those catch-up contributions. I say it loud and proud. I'm making my catch-up contributions. I'm that old. For many women, though, the trade-off is worth understanding. So call me if you don't get it. Okay, lastly, new retirement accounts for children. You've heard about these Trump accounts out there. So if you're young and having kids, if you're a grandparent and your daughter's having kids, or daughter-in-laws, or babies are everywhere, pay attention. Children born between 2025 and 2028 receive a $1,000 federal deposit into this new retirement style account. They're calling it the Trump account. But families can add to this. They can contribute up to $5,000 per year after tax. Super important point here, after tax. So you're not getting a deduction if you put money in your kid's Trump account. At the age of 18, the account converts into a traditional IRA. See, this is the idea here is that they're trying to create generational wealth. Between you and me, by the time the kid gets to be 18, if you put 1,000 in at birth and you go with there's that old calculation that says your money doubles every 7 years. Well, double the 1,000 to 2.5 times, you're at like $6,500, $7,000. Not life-changing. Could be very helpful. Very important to note, though, you cannot pull this out for college. This is not a 529. This is the administration's way of trying to create generational wealth, long-term compounding from birth. I mean, look, any 18-year-old is going to wake up one day and look at his Trump account and have $7,000 and be tickled as hell. Fantastic. But again, that kid who probably wants to take that money and go cross country has to be reminded that that is for retirement. Long term, we are trying to set you up for a better future. Okay. Big picture here now. What matters most with all this one big, beautiful bill act stuff? Predictability. This big old act gave us predictability. The tax brackets are now largely permanent. This gives us something we haven't had in years, stability. Prior years, I mean, for someone like me who's a quote unquote planner, how do you plan when you don't know what the heck the future is going to be? Because the brackets were this, to this number till this day, and then they changed to this day, and it was like you need a Dramamine to follow it. Stability is really good here. So this is good for planning, and it reduces financial anxiety. But it doesn't mean it also makes things simple. Quite frankly, things are still complicated, and they always will be. There are thresholds, there are phase outs, there are planning decisions. And for women in particular, life transitions matter just as much as tax law changes. If your filing status has changed in recent years, divorce, separation, widowhood, your tax picture may look very different than it did when you filed jointly. And that SALT deduction, which we didn't even mention, the state and local tax deduction cap was increased to $40,000. Under the new law, this might provide tons of relief for homeowners, especially in those high tax states. So if you live in New York, New Jersey, Connecticut, California, all the states that are broke, basically, you now have this state and local tax deduction that could be really helpful, especially calling all you divorced women out there that insisted on staying in the home. This could be helpful to get you through those years where I know I was there in the beginning. It is so hard to manage that house on your own. Okay. As all things, though, how much you benefit on this stuff depends on your income, your filing status. Are you married? Are you filing single? Married filing separate, even married filing joint? Divorce reminds us that when you move from two incomes to one, from joint to single, the math goes bonkers. It totally changes. So that's why you cannot assume anything. I'm old enough to remember the odd couple episode. Remember when he said, when you assume something, you make an ass out of you and me? Anybody else remember? It's best. Anyway, you can't assume your old strategy is going to work. Life changes, tax impacts change with it. So before you file your 2026, ask yourself a bunch of things. Did my income change this year? Am I near a phase out? Did my filing status change? Basically, did my life change? Are you head of household now because you're divorced and you have the kids? Ask yourself some questions. And did my Roth catch up contributions shift my long term strategy? And lastly, ask your tax preparer or accountant, what should I be doing now before the end of this year, before December 31st? Tax preparation looks backwards, but tax planning looks forward. And may I just say, if your preparer doesn't have suggestions for you for now until the end of the year, find a new preparer. Okay, for women especially, tax planning isn't about this year's refund, although it's a beautiful thing when you get one. And many, many people are expected to this year. Tax planning is about protecting the next 20 years. Women who understand the rules build wealth with intention, and intention compounds. I love compounding. Look, you don't need to memorize the tax code, but what you do need to understand is how it affects your life. Because when women understand the rules, we make decisions differently. Quite frankly, we make better decisions. We plan differently, we build differently, and that matters, especially in the years when laws change and headlines feel loud. And that is an understatement these days. Okay, look, if this episode helped you, I created this simple printable checklist that you can bring to your tax appointment, or email it to your dude, your person, woman, whoever. It's called the 2026 Tax Planning Checklist for Women. It walks you through the exact questions to ask before you file. You can download it at my site, tracyburnswealth.com. Again, tax preparation is backwards looking. Tax planning is forward looking. We are only looking forward these days. No more looking back. That's behind us. Again, we want to protect what we have in the next 20 years. All right, so as always, you can find us on Spotify, Apple, iTunes, oh, I said that wrong. Look at you, you're so good. Hold on, I'll read that again. 3, 2, 1. All right, so as always, you can find us on Spotify, Apple Podcasts, YouTube, and of course, you could find us At my site, tracyburnswealth.com. You can find me on LinkedIn at Tracy Byrnes. Share this episode with someone who works overtime, earns tips, is trying to navigate retirement, or just wants to make sure there are less surprises in April. As always, stay informed, stay confident. Take control of what matters most: women, wealth, and what matters. Lebenthal Financial Services, Inc. is a FINRA registered broker-dealer. The content of this podcast is intended for informational purposes only and is not intended to be investment advice. The views expressed in this podcast are subject to change based on market and other conditions. Information about the qualifications and business practices of Lebenthal Global Advisors, LLC is available on the SEC's website at www.advisorinfo.sec.gov. Information about the qualifications and business practices of Lebenthal Financial Services, Inc. and its representatives can be found on FINRA's BrokerCheck website, which is brokercheck.finra.org.